Welcome to the Doctors Making a Difference podcast, where we help physicians to be empowered with the tools they need to be successful in medicine, in finance, and in life. Join us as we highlight doctors and other professionals around the world who are making a difference. Hello, everyone. Today, I am excited to welcome our guest, Jonathan Spitz. Most of the time when we do these podcasts, we are featuring physicians who are making a difference, but occasionally we have tools and resources that are really useful to doctors. And today is one of those episodes. I'm excited to welcome John. He gave me the permission to call him John. He is the head capital formation at Lightstone Direct. He oversees business development for that company, Lightstone Direct. He'll tell us more about it as we go through, but this will be an interesting episode, I think, as we talk about some resources and tools that most physicians should probably consider at some point in their financial career. And so, Jonathan, would you mind introducing yourself in more detail to our audience?
Yeah, thanks, Peter. Good evening or good afternoon, depending on where you are, what time you're listening to this. My name is Jonathan Spitz. As Peter mentioned, I head up capital formation at Lightstone Direct. And really what that means is I work with our investor base to educate them on our investment offering. So no matter what experience level, we have investors that range the experience level. My goal is to just educate and meet our investors where they are on their real estate investing journey.
One of the questions as we go through a podcast, it's nice to know who we're talking to. So how did you get into investing, Jonathan? That's an interesting journey to become an investor. And then to specifically start working with physicians over the last 6 years.
Yeah. So I've been in the real estate business for over a decade. When I graduated college, I had no intention of going to real estate. I always thought I was going to be on the public equity side of the business. So public stocks and equity research, and really ended up in commercial real estate brokerage in Tampa, where I'm from, and really just fell in love with the business. And from there, really worked in a number of different capacities with various firms. I worked for a firm called Invitation Homes, which at the time was a private organization. It's now a very large publicly traded single family home REIT. I worked for a community bank in Chicago, where I predominantly worked on financing commercial real estate projects throughout the Chicagoland area. And then I joined another private equity real estate company called Origin Investments in 2020. And so that was really when I started working more on the capital raising side of the business, which is what I do today and what I've been doing over the last 6 years. And what's been really interesting about this journey is just experiencing the ebbs and flows of the market. Again, working with investors from all different backgrounds, right? I've worked with many physicians, some coming straight out of residency, some that have been in the business 15, 20 years and approaching retirement, and everyone in between. I've worked with wealth managers, I've worked with family offices, worked with business owners. So I think what's been really interesting about working in this capacity is, everyone's got different investment goals. And part of our job at Lightstone, and my job, quite frankly, as a capital formation associate, is really when I'm working with investors, is to understand what those goals are and figure out if private real estate is right for you. And so that's really what I spend the lion's share of my time doing, is working with people, figuring out what it is, why they're interested in real estate, if what we're doing is the right fit, making sure they understand the risks of these investments, the liquidity profiles, the potential returns, you name it. Right. And so again, that's really what I spend a lot of my time doing.
Yeah. So maybe back up a couple steps. I'm just thinking the majority of the audience who listen to this podcast are physicians, and they range just like what you said, Jonathan, people who are in training, those who are just barely out, and those who have been at it for a while. And so maybe just for the sake of education, just teach us a little bit. What's a REIT? What's the difference between a REIT and a direct investment with a company like Lightstone Direct? And how does that compare and contrast, with like if you went next door and bought a house that you wanted to rent out? So maybe just give people a little bit of a flavor of what the market looks like with real estate.
Yeah, 100%. So let's start from just the perspective of being active or passive. So if someone wants to invest in real estate, they can choose to go buy a property on their own. That would be active management, where you are leasing the property or hiring a property manager. You are owning it and managing it day to day. And some people really like that aspect of real estate, is dealing with the tenants and having control. But then the other side of the coin is investing passively. And especially, I think the reason why so many physicians gravitate towards sort of a passive position is because physicians, you guys are some of the busiest people I know, right? Some people do active management and some people do both, right? Some people want to own their own properties and have passive portfolio exposure as well. And I think for one, the starting point there is most people are managing or owning real estate directly, they most of the time are doing so in their backyard, right? Peter, that'd be like you owning property in Idaho or me owning property in Tampa. Whereas when you're investing passively with a manager, that opens up to what type of asset classes you can invest in, the types of strategies, the locations, property types. So that just really expands the universe of what you're able to invest in. Now, if you're investing passively, you can do through a publicly traded stocks, or you can do so privately through alternative investments. And so one of the ways you can do it publicly is by investing in publicly traded REITs. That's a great way to get exposure. You can invest in. And the great part about investing publicly is you can choose to get exposure to certain sectors, or you can own a broad basket of all of the public REITs. So VNQ, I believe that's the ticker, is the all REIT index, if you will, the Vanguard all REIT index. I believe that's the ticker. Or you can get sector specific exposure. You could buy Camden Property Trust, which is Sunbelt multifamily exposure. You can invest in ARE, which is pure play life sciences exposure. Prologis, which is all industrial exposure. So you can still mix and match in the public markets, but you're generally buying very well diversified funds, essentially, or portfolios where their strategy is predominantly income oriented. So the whole goal of a public REIT is really to generate. REIT by definition have to pay out 90% of their income through a dividend. And so you're usually getting 3 to 4% dividend. That's the reason why some people don't like REITs, is because if they're looking to diversify their portfolio outside of publicly traded stocks, the thing about REITs is that you are going to have a correlation most likely to the rest of your publicly traded portfolio to a certain extent, right? And some people just don't like that volatility. As an example, when interest rates started going up in 2022, that had implications for private and public real estate. But public real estate, you were seeing 30, 40, 50%, 60% drawdowns in the underlying public security, because the public stock can trade at a discount or a premium to whatever the actual intrinsic value is, or the net asset value of the underlying real estate, right? Private real estate, however, is generally marked at whatever the prevailing net asset value is. And again, or it trades, so you don't have the same level of volatility. Now, you can invest in private REITs as well. So it's a similar strategy as what you get on the public REITs. But again, you're not going to be subject to public market volatility. Then the last way you can invest, which is, or one of the last, and there's a number of different ways, so I won't go through all of them. What we do at Lightstone is we invest in individual investment opportunities. So I think a good analogy would be like, instead of buying the S&P 500, you're buying shares of Apple, or you're buying shares of Procter & Gamble. Like, you're buying individual assets and building a portfolio yourself, right? And so we still very much believe in diversification, but the way that we've invested across our 40-year history at Lightstone is by being very selected and making very high conviction investments across a number of different sectors, right? We invest in apartments, we invest in industrial, we invest in life sciences, retail. Really what we believe in is, again, just making those investments on a deal by deal basis. So that's, without going too long, those some of the differences between public and private, and investing in maybe a diversified REIT or diversified fund, or making individual investments and building a more selective portfolio and having more control of which individual assets and markets you choose to invest in.
Yeah. So I'm just going to summarize for a second, because again, I'm envisioning myself in my first 2 or 3 years as an attending physician. I didn't know what REIT meant. That means real estate investment trust. And because unless you've really applied yourself, there's not a natural place where there's lots of teaching that happens in the medical process. And you come out of residency, and most people are in their late 20s or somewhere in their early half of their 30s. And a lot of their peers have said, hey, I've been investing in an index fund for 15 years and I've been doing this. And you kind of, as a medical student or a resident, your eyes might just glaze over. I've been working 90 hours a week. What are you talking about? And so it's good to step back and say, when you enter the world of attending income, you need to be a really good guardian of that income. And part of that process is to be able to put aside your 20 or 30% of your income, ideally, towards something that's going to build long-term wealth. And you and I talked just for a second before we hit record. I don't think somebody that's brand new, very first job, first time they ever received an attending paycheck, probably shouldn't go spend all of it on individual real estate. They probably ought to diversify a little bit. And like you said, one of your jobs is to identify who's appropriate for working with something like Lightstone and who should just be putting something in an S&P index 500 index fund or something like that. And so I guess one of the questions I want to follow up on that, who's appropriate for this? For someone who says, I want to move away from publicly traded things to something where I'm a little bit more directly owning investment properties. And also, what percentage of my asset allocation should I be putting toward real estate versus how much should be exposed to the market through a traditional index fund or something like that?
Yeah. So tackle the first one first, which is, I think the biggest, who is it right for? I think the biggest thing that I always want to make sure people understand when they're considering this as a potential part of their portfolio are the differences in the liquidity profile of what we do versus investing in public markets, even public REITs, right? If you are invested in public securities, you can hit the buy and sell button at your leisure. You can get liquidity same day or next day. That is not what you can do in most private alternative investments, and real estate's no different, right? Now, these days, there are semi-liquid REITs that provide some liquidity, but there's usually a cost for that. Like what we do at Lightstone is we're generally doing some type of value add deal that is anywhere between 3 and 5 years. And so now there's cash flow generally throughout the life of the investment. But let's say that you needed that money, like your actual principal. Let's say you invested 100 grand as an example, and you needed to tap into that 100 grand a year later. We're not going to be able to provide that for you. The way that the liquidity happens in our world is once that investment is sold. Some people now, who is there right now? How much should somebody have of this? It is what I've learned in my 6 years is that everybody is different in this regard. Because me personally, some of the worst investment decisions I've ever made in my career have been because I have the ability to sell. And when I'm watching the market go down 30% or 20% during COVID or during 2022 or 2020, when the market went down 20%, I'm an emotional human being. And so I make really bad decisions when I'm emotionally charged. And so I said, I don't have a wealth manager. I manage my own portfolio, and I've made the worst investment decisions of my life selling at the absolute bottom. Like I am terrible at managing emotions when it comes to my own money. And so the one benefit to investing in something more illiquid is that you're forced to ride that out. And we see this, right? It is human behavior. Unfortunately, when people are actually investing the most is usually like the worst time to invest. And when people don't want to invest is actually when you probably want to be investing the most, right? So again, some people, but that's not for everybody, but some people, like I totally understand. You should always have a good chunk of your, I think, portfolio in something that is more liquid because you just never know what's going to happen. You need to access that liquidity. But I do think that there is a role for having private investments. I don't think necessarily for the reasons of managing volatility, but more just because you can usually get some more upside than what you might be able to get in the markets. And you're really forced to ride out periods of market dislocation. And I think that is most of the time to the investor's benefit rather than trying to pull your money at the absolute worst time. So again, I've met investors that have, and advisors too. I've worked with a lot of advisors. They very much believe in more of the Yale endowment approach and having 60, 70% of their capital tied up in illiquid investments. I'm not saying that's what you should do. Most people are putting anywhere between 5 and 15 to 20% of their investments in illiquid alternatives like real estate or like private equity or something like that. But what I've learned is it is very much dependent on the individual and their comfort level. I think what most people like about real estate though, is that it's easier to understand generally, especially if you're investing in an apartment building or even industrial. Usually when you have a conversation with people understand the business plan, it's much different than investing in maybe a business or something like that where there's more moving parts. But again, everyone's journey is different and their investment preferences are generally different as well.
Yeah, I guess one of the big points, and I had someone that taught me this a little bit when I was at the very beginning of my career, and I was thankful for that. But I don't feel like it was really incorporated a lot into our formal training. And one of the big things is you need to put your money to work for you. If you have it in your savings account only at your bank, recently that number's been a little higher, that those savings accounts return a little bit more. But traditionally, it's been less than the inflation rate if you leave something like that. So the big message of the day is you got to invest in something that will allow that money to grow slowly over time. And you can diversify across real estate or, like I say, stock market index funds. There's a lot of things you can do, but one of the most important things is to recognize those risks. Like you said, if it's illiquid, you can't access that money during that time of it. For Lightstone Direct, how long would you say most of the asset, or like what's the timeline on most of the investments from investment to when you expect that to pay back, or do you have a permanent ownership in that, or what's your typical setup on that?
Yeah, generally speaking, we're investing with a 3 to 5 year time horizon. So we very much follow, not always, but oftentimes we're following what I would just simply put as a buy, fix, sell strategy. So we're buying an asset that is underperforming for some reason. So maybe the property needs physical capital improvements. Maybe the rent roll is below market. The rents on the rent roll are below where the market is today, or the property just hasn't been performing operationally. And so we'll come in, and again, we're vertically integrated. So we have an in-house asset management team. We have in-house property management for our multifamily strategies. So what we're doing is we're coming in, we're buying assets that have cash flow day one, that pay a dividend over the course of 3 to 4 years. And then after we have executed that value add business plan and stabilized the building, then we look to sell that investment to someone that is looking for maybe an investment with less risk, some more private capital, institutional capital. And that's when investors earn back their capital, plus hopefully some type of return on top of the distributions that we've paid along the way.
Okay. So just as an example, if somebody put the number you gave, if you put $100,000 into it, you could expect somewhere in 3 to 5 years that asset is then sold and you gain the proceeds. But in the meantime, there's some payback that comes during that. But you can't go back and say, I want my original $100,000 back today. You have to leave it in there for that period of time. And with that in mind, what are the typical rates of return that I realize that's something you can't predict because future market volatility is something that none of us can predict. But in general, what do you see that compared to like an index fund or more of a stock market based approach?
Yeah. Well, I mean, right now, historically, the S&P 500 right now, especially after the last three, it used to be about 8%. Now it's like around 10% because it's done so well over the last couple of years. But just using that as your benchmark, let's say the S&P 500, it gives you 9 to 10% a year on average, which is more on the optimistic side. So what we generally look for is anywhere between a 14 to 16% annualized return, net IRR. So that difference there is what we would call the liquidity premium, right? So you're getting an extra 6% in return, that's the target, right? For trading liquidity, meaning that, like we talked about earlier, that you won't be able to access that through the life of that 3 to 4 year hold. Now, one benefit for us is we're targeting generally 14 to 16% over 4 years, but that's what we're not saying is that you're going to get 14 to 16% every year. The way that return is actually earned is quite lumpy. During the first 3 or 4 years, we're paying a distribution rate of anywhere from 6 to 8% on average, just depending on the deal. Now, what I've learned just working with a lot of physicians, and most physicians, it seems like the number one thing they care about more than most other cohorts, and for obvious reasons, is tax efficiency. Because you guys, physicians are generally obviously high W-2 or high income earners and taxed enough. So I think why so many are drawn to real estate is that you're able to earn tax efficient income throughout that 3 to 4 year period before realizing the profit from selling the investment in year 4. So that's what can usually make it so attractive. So we're earning, but again, there are strategies you can take that maybe you're earning 10 to 12%, but it's far less risky, or you're shooting for 18 to 20%, but there's significantly more risk attached to it. And usually we like to play in that middle of the field of 14 to 16% type of returns. And because we don't really use a lot of leverage on our deals, if most people can understand this, when you're buying your home, you're usually putting a mortgage on it, and you may put 50, 60, 70, 80, 90% debt when you're purchasing a home. Real estate's no different. When we're buying a property, a bank will come in and give us a loan. I think what differentiates Lightstone is we're being very conservative in the amount of debt that we put on a property. So as an example, we have a project right now that we've just recently launched. We're only levered at 54% loan to value, right? So as an example, if it's a $100 million deal, that means we have $54 million in debt on the property and $46 million in equity. So that's generally, especially by investment standards, very conservative. And again, like one of our core tenets is wealth preservation first, tax efficient income, and also generating some very tax efficient capital appreciation over the life of the hold. But again, wealth preservation being very much first and foremost as far as how we think about this from a risk management perspective. Because again, and we haven't really talked about this, but we put a lot of our own money in these deals. So the big differentiator at Lightstone, we put at least 20% of our own capital in every deal we do. So again, and we've been investing for 40 years. We invested throughout the great financial crisis. We got punched in the face and lost money on a deal. And so that's really helped inform how our organization operates today, which is thinking about things from the downside perspective first. So how are we going to lose money in this deal? That's the first thing we think of. And then we work from there. And a lot of that is how much debt we take, how much cash flow the building is producing. Are we stress testing different scenarios? What happens if all the tenants leave this industrial building? What happens? Like we look at that. It's called an as vacate scenario. We look at that all the time. What happens if the tenants renew? What is our strategy if we do this? How do we need to build cash reserves for this scenario? So all of these, my old boss used to say something, I love it. Risk management is about the decisions you make before a disaster or before, not a disaster. Risk management is about the decisions you make before a recession, not during. And that's really much how we think about it at Lightstone. And again, like we don't want to take on too much leverage and we like being in that, let's call it 14 to 16% type IRRs on deals.
That's one of the things that I found really engaging and attractive about Lightstone Direct when I read about it, when I came across your information. The fact that Lightstone Direct invests 20% along with other investors is a big deal. It's not just you arranging a deal for somebody else and they take all the risk. Lightstone also is very much in that situation with all investors. So everybody should have the same motivation. It's a win-win. Is if they do well, Lightstone does well. If they do poorly, Lightstone also does poorly. So it's good to assess all those risks. You can't take risk out of these things. There's risk with investing in just about everything, including the stock market. And so it's important to assess that risk. And I like that you said you're not targeting the most risky assets, but you are targeting something that's getting more of a 14 to 16%. And it's a trade-off for having those resources that you put into it illiquid during that time. And so that's a good education piece for our audience and for me and for all of us to understand what piece this has in building it. One of the other questions I wanted to ask you about that is, as a person is building their profile. So say you work with doctors and say somebody's somewhere in maybe 6 to 10 years after they've finished their residency, they have a mortgage on a home, they've been investing in whatever their 401k allowed them to invest. When you start looking at kind of total net worth and stuff, when would you say that's appropriate for a person to invest in real estate? Like we said, maybe it's not the appropriate thing for when someone is brand new and has nothing but debt and is in their very first 1 or 2 years of residency. But when would you say it's appropriate for somebody to take on something like this as part of their portfolio?
Yeah. What we see most frequently is people that are in the net worth of $2 to $3 million range at that point. Right. And so again, you're taking maybe a 5% position in your portfolio or a 3% position in that first real estate investment if you're making a $100,000 check or whatever. But again, it's really a personal preference at the end of the day. But what we see is just across our own data from investors that are investing at Lightstone, 2 to 3 million seems to be sort of the sweet spot, I would say, is when people start to think about and making an investment. But sometimes what I've learned too is that people that maybe their net worth isn't there and their income is there, maybe they'll take a portion of their income and they'll do one deal a year. We see that too, right? So one deal every couple of years they're doing. Again, it just depends on the individual.
Yeah, I think it's an important part of the conversation. Like this podcast goes to people of a variety of different career stages. And most physicians, if they will put aside about 20% of their gross income year by year, even if you had it in a total stock market fund or an S&P 500 fund, the rule of 72 or whatever that rule is says that most things will double about every 7 years. So you can see that by somewhere around 8 to 10 years in, most doctors should have more than $1 million saved. And then over that time horizon, that can increase. And then you really do need to say, how am I diversifying this? How am I building long-term diversification? And how's that going to serve me for financial independence in the future? This is an important tool that we've talked about. What mistakes have you seen people make as they assess this risk?
Oh yeah, there's a lot, but I would say the biggest mistake I see all investors make, physicians, individuals, it doesn't really matter who, is getting enamored with very aggressive target returns. We'll see this often is that we put a deal out and people are like, oh, 15% is too low. I have another manager that's going to do a 20% ERR. And I'm like, okay, well, can you send me the deck? Can I take a look at it? Like the deal that you're looking at? And they'll send it to me. And it's like, well, okay, here's a couple of differences. One is this deal is they're borrowing at 80% loan to cost. That's high, right? So the capital structure is significantly more risky, which everyone, if you're not living and breathing this, what I do every day, you may not notice. So I would, as a cautionary tale to anybody that's investing, one of the first things you should ask is how much debt are you going to be taking on this property? When you think about where most people go wrong, almost, I'll say it again, it's like leverage, too much debt. The second thing is maybe not doing enough due diligence on the manager. But I tell everybody that's talking to us, and they'll ask me all the time, who are your biggest competitors? And I'll give them a list of names. And with that, I'll create a bunch of questions. Not only you should ask us, but you should ask any manager. What's your track record? How long have you been doing this? Tell me about how long has your investment team been investing together? How have the strategy that you're trying to raise money for right now, have you executed it before? Talk about how much are they actually investing in the deal? Like there's just a lot of different questions that people ask. I think sometimes people may get overly focused on the individual deal and the way that's presented in a deck, as opposed to understanding now who's behind this, who's actually executing this strategy that's going to be responsible for generating the returns. Because I would say most people should focus on underwriting the manager as much, if not more, than underwriting the individual deal. And again, there's a lot out there. And again, I'm happy to speak with anybody as far as that is, I think, a challenge sometimes. Sometimes people just don't know what questions to ask. But now there's so many more tools at people's disposal, whether it's ChatGPT, many blogs that have been written. There's definitely a lot of physician groups out there that they focus on this, in investor clubs in general, where their sole purpose is to focus on evaluating managers and evaluating these types of investments, because they can be, it can be a lot to look at, right? That's a big difference between going out and buying Apple shares or going out and buying an S&P index fund and doing one of our deals. If you want to do one of our deals, what I'm going to send you is a deck, a prospectus, like a private placement memorandum that's 60 pages long, an operating agreement that's another 30 pages long. And that can be a lot for someone to read. And there's a lot of legal language in there that you may not. And again, that part of my job is to help walk people through all of that, but it's a lot to look at. So it's a very different evaluation process. And some people will make these types of investments without doing enough due diligence. So sometimes it's just understanding, what questions do I need to ask? What is this manager's background? Have they done this strategy before? And then what are their underwriting assumptions? How much debt are they using? Again, there's nuances to the individual deal, but I would really start there for anybody that's starting to evaluate this space and figuring out what direction to go.
No, that's really useful. I've two things you've said that make Lightstone Direct stand out in my mind is that it's got a 40-year history, stood the test of time through various financial situations. And the second is that there's a 20% co-investment happening where Lightstone's directly investing its own assets and capital into these deals. Are there other things that make Lightstone Direct unique or different than other similar investing platforms?
Yeah, I would say one is just, we are a $12 billion organization, but we're still very entrepreneurial in a sense that not only have we invested across multiple market cycles, but again, because we invest so heavily in everything we do, we just look at things through a much different lens than other managers. And again, it's why I can't emphasize, like people will say, oh, skin in the game. What does skin in the game actually mean behind the scenes? I can tell you, as someone that sits in investment committee every Tuesday, what it means is just an unreal amount of scrutiny for deals that go through our platform. Like sometimes I just feel bad for our acquisitions guys because their deals just get put through the ringer. And that is because we put so much of our own money in these deals. And again, I mentioned earlier, just like the level of the different scenarios that we look at deals to examine, like the different outcomes and how they impact our returns. So I would say that, but then two is, again, we invest across just a number of different asset classes. A lot of managers, they may invest only in Sunbelt multifamily real estate, or maybe they only do multifamily in the Midwest, or like they're much more specialized organizations. There are certainly benefits to that, but the problem with that is they can't always necessarily be objective about, if the tide's moving against them, investing in something else, where we have that ability and that agility to do so. And as an example, like for us, like it's been really tough to make deals in the southeastern portion of the United States for multifamily assets. They don't really work mathematically for us, right? But we can invest in the Midwest in the multifamily, and those look good. We can invest in sub-institutional Class B industrial buildings. So I know that's a lot, but just multi-tenant industrial buildings where we see there's opportunity there. And so the fact that allows us to be more objective and really follow wherever we believe that the best risk-adjusted returns are going to be. And I think that's a huge advantage for us.
Yeah. One other, just as we talk about this asset class in detail, what other advice would you give physicians? Again, you've identified the ideal person as someone that says, okay, I'm getting to that net worth class where I probably want to diversify. I'm interested. I've educated myself about private real estate deals and I'm looking for this opportunity. What other advice would you give physicians to look like? What do they, obviously this is not personalized advice. This is a general forum for people to receive information, but where would you tell people to go outside of contacting you directly? Is there any other place that you would want them to seek information?
Yeah. I mean, look, if you want to learn more about us specifically, I would say go to lightstonedirect.com. But I would say if you're on your real estate investment journey and right now you're trying to learn more about the space and how to invest, and like there are a number of different like investment clubs that you can join. I can just rattle off some. In Boulder Investment Group is one, 506 Group is another. There are some physicians forums out there as well, which you can join. I believe White Coat Investor. There's all sorts of different groups that you can join that are essentially peer groups of individuals. Long Angles, another great one. These are all individual high net worth investors that look at deals together and people provide their opinions on them. And you'll hear from people who have invested with that manager before, and they'll tell you if they've had a good experience or not. There's no better thing you can have than a personal reference from somebody that has invested with that manager before. And so that's the great part about where we are today in general is you have so many groups and communities out there that are built for different purposes. And all of these are some of the ones I dropped are all names of communities that exist to support each other and to help and to educate each other on learning about the space, because in general, alternative investments are becoming a significant, a larger chunk of people's portfolios, but the learning curve can be steep. And so this help compress that time frame by being able to talk to others that are maybe been doing this a little bit longer and to help you avoid some of the pitfalls that people make.
Yeah, no, like you said, you're seeking for the win-win. Educated investor that knows what they're about. They've got the appropriate net worth and appropriate understanding of risk and the illiquidity of it. And then you couple with someone like Lightstone Direct and you gain information from someone like Jonathan Spitz. And then it can be a win-win over that period of time because you co-invest in that and then it can really help. So how can people get a hold of you, Jonathan? If you go forward and someone says, okay, I think this actually fits what I'm interested in doing, how do they contact you outside of just going out through Lightstone Direct? Or is there a LinkedIn profile or a direct web page or any specific place you would want them to go?
Yeah, I would say you can reach out to me directly. My email is jspitz@lightstonedirect.com. And I really enjoy talking to people that are newer in their journey and again, like we don't have to talk about our offerings. If you just want to understand, what to look for, I'm happy to have conversations with people and just be a resource. Because at the end of the day, like the more that we can help and just be a resource on that, look, hopefully eventually you enjoy what we're doing at Lightstone and maybe you make an allocation with us. But if not, like the more, whatever we can do to help add value in your journey, I think that's great. So would love to hear from anyone. Shoot me an email anytime. I'd be happy to jump on a call.
That's awesome. Hey, I've really enjoyed this, Jonathan. It's been super instructive. And I think people will gain value from this, whether they're at the very beginning of that journey or they're well advanced and they're looking at different options. And so I appreciate you going over all that. Any final words or thoughts you've had as we wrap up our time here?
No, I would say, no, look, we think that now is really an interesting time to start considering the real estate space more broadly, whether it's you're going out and looking for a rental or whether you want to invest in public REITs or evaluating private real estate. We didn't really talk too much about what the forecast is there, but look, we think that right now interest rates are starting to moderate finally. And we think now is a really exciting time to start thinking about the space because the last 3 years have been a very challenging place to real estate has not been the darling of the investment universe over the past couple of years, but we think that's about to change in a big way. If anyone's curious or wants to learn more, like I said, feel free to reach out to me directly. Happy to talk about that more.
Thank you so much, Jonathan. I really appreciate it and hope you keep in touch, and I appreciate you being a guest on the podcast today.
Yeah, absolutely. Thanks, Peter. This was fun.
Thank you. Thanks for tuning into the Doctors Making a Difference podcast. And thank you for what you do to help your patients and your community. Your work truly helps so many people. We produce this content to help you have the tools you need to stay in medicine and to highlight the amazing work being done by physicians around the world. Please note that while I am a physician, and many of the guests on this program are also physicians or other professionals, the discussions on this podcast do not represent my employer or any professional organizations to which I belong. This podcast is for your information and entertainment only, and should not be taken as professional advice. You should seek appropriate professional advice pertaining to your own situation. Please check out more of our content on our website, doctorsmakingadifference.com. Also, please follow, like, or subscribe on your podcast player or YouTube channel, and give us a 5-star rating. It really helps to spread the message. Finally, if you'd like to be a guest on the podcast, or if you'd like to nominate someone else to be a guest, please visit the website or email admin@doctorsmakingadifference.com. See you next time.